Hi there, this is Mr. Evans. This video is looking at capital structure as a financial objective. So it comes under this bullet point here, the proportion of long-term funding that is debt and the capital structure objectives noted down there. So capital structure objectives are targets relating to the extent to which the business is financed by its owners or by money borrowed from external sources. So when a business is being set up, usually the owners will invest some money, usually a quite considerable proportion of the startup funds will have to come from the owners. No one's going to lend the business money if the owners aren't putting money in. But often businesses will need debt to borrow money to start the business, and they may well do that from a bank or even crowdfunding these days is a popular way of borrowing money. So there's a few key terms that you really need to be aware of. So long-term funding is known as capital employed, and it shows where a business has got its money from. So what I mean by long-term funding is the money that's been invested into a business, and that can come from a number of places. It could come from share or equity capital. Okay, so that's when we're talking about capital in finance terms, what we're talking about is money that's been invested in the business. So where does this money come from that's been invested in the business? When we're talking about capital in terms of operations, of course, we're talking about the machinery, the factories, the buildings that a business uses to produce its products. But we've got a different meaning here. Share or equity capital is money that has been invested by shareholders or owners of the business. Debt capital is money that comes from that's been borrowed, basically, usually from banks, but there are other sources as well. And also retained profits adds to the capital employed if that money gets reinvested in the business. Share equity capital is money invested by shareholders. Debt capital comes from banks in the forms of loans and mortgages and needs to be repaid. Just a quick word on terminology in this unit. Finance, more than any other unit in my opinion, has got a number of key terms that you really need to be able to use accurately. Using an app like memrise.com or just old-fashioned flashcards, really get to know these key terms so you can use them accurately. So, how do we work out the proportion of long-term funding that is debt? Well, there's a formula here for you. Debt capital divided by total capital employed times 100. So let's break that down for a second. Debt capital is the amount of money that's been borrowed. The total capital employed is the total amount of money that's been invested to get the business off the ground, and we multiply that by 100 to work out what proportion of the total money that's you've been used to get the business off the ground is from debt. So let's just take a really easy example. Let's just say a business total capital employed is 100,000. The share capital is 55,000. That means, of course, that 45,000 has come from other sources. If this is the only capital in the business, i.e. there's no retained profit, you can see that 100,000 has been largely financed by shares, but also partially financed by debt capital. We put the numbers in. 45,000 debt capital divided by total capital employed of 100,000 times that by 100, and it tells us this company is 45% funded by debt. So this is also known as gearing. It's a measure of risk because the more debt a business has been founded on, the more debt a business has incurred, the more the business is vulnerable to changes in the interest rate. Obviously, debt needs to be paid back. So if the business gets into financial difficulties and can't do that, that can put the business at risk in the future. Anything over really 50% is considered relatively highly geared, and that business would be seen as perhaps a high risk business to invest in by shareholders. In terms of the sort of objectives that might be set around this, well, businesses, over 50% is considered to be quite high risk, and that business would almost certainly struggle to take out additional loans if it was going to a bank looking for more loans and already had debt capital of over 50%. But also some investors may consider that a business is too risk-free. They're not ambitious enough. If they've got anything less than maybe 20%, they haven't borrowed any money, in other words. Investors might be asking why. Is this management, why have they not borrowed some money to expand, to get bigger? The managers worried they can't pay it back, etc. So shareholders might actually worry if a business doesn't have enough debt. So the objectives that might be set, if you've got a low level of gearing, you might set yourself the objective of borrowing some money and expanding. If you've got a high level of gearing, you'd probably be looking to reduce that by paying off some of the debt and getting yourself below 50%. Oh, I thought that was the end. So just to quickly go through the difference between share or equity capital and debt capital. Equity capital, money invested by shareholders, doesn't have to be repaid. Shareholders might expect an annual dividend payment, but they're actually not entitled to it. So this is good for a business if they don't make a profit, because they don't need to pay their shareholders anything. So that's an advantage of funding by equity capital. 1 year, very high dividends may be paid. The following year, the shareholders may accept lower dividends to allow the business more funds to invest. So, equity capital is more flexible for the business in terms of the returns they give to their shareholders than debt capital. However, shareholders are entitled to a say in how the company is run. They're allowed to attend the annual general meeting, and they can even appoint new people to the board of directors. And so shareholders have got more control in a business because shareholders are the owners of a business than a bank does. So there are some pros and cons of funding by equity capital. Debt capital, predominantly borrowed from banks, although there are other methods used, including crowdfunding. Debt capital is money borrowed by the business in order to invest or set up. The money is repaid over a set period of time, depending on the loan. Most bank loans are 3 to 5 years. Overdrafts are shorter, but we'll get into that in a later video. An annual interest rate is usually charged for a loan, although that's usually lower than dividend payments might be. And the bank does not get to share profits, so it's great if you make a load of profit with the investment. The bank only wants their money back with some interest. But on the flip side of that, you've got a set schedule for repaying the loan over, say, 3 to 5 years, and the bank won't take very kindly to you saying that you can't pay them because you haven't made enough profit. So there are pros and cons to each form of financing the business.